Here is the easiest way to start Forex trading this year and become a profitable trader. My goal is to fast-track your trading journey and scale you up quickly from a beginner to an advanced trader in a matter of minutes. Gone are the days when you have to trade for 6 years and be learning from just too many lessons before you become profitable. We got no time for that. Time is precious, and this I have always proven in each video on this channel. The reason why many traders keep repeating mistakes and keep losing consistently is because they always choose to ignore the simple things in trading, and they have no mentor to guide them through. But hey, in this video, I will be holding your hands as I lead you step by step to becoming a bigger version of yourself. And by the end of this video, we'll be gifting you a simple strategy that you will be using to make at least $100 daily, even as a complete beginner. So subscribe to this channel if you are new. And as you do that, smash the like button and turn on the post notification so that YouTube can notify you each time I drop a video on this channel. Now let's get down to business, as I will be simplifying everything for you in this video. Now, what is Forex trading all about? Forex trading is simply the exchange of currencies, and when we trade, we intend on buying or selling a particular asset in the market. This could be currency pairs like the GBP USD, metals like the silver and gold, and we also have FX tradable cryptocurrencies like the L2C USD, the B2C USD and many more. But hey, these ones are not the normal cryptocurrencies you trade on exchanges like Binance, where you can buy and hodl for long. These are Forex assets granted by brokers, and yes, you can benefit from both buying and selling positions, but when the trade goes against you, you will be taken out of positions and you will lose the dedicated amount. You cannot hold cryptocurrency assets in Forex trading. There are two ways of analyzing and understanding the Forex market: fundamental analysis and technical analysis. Fundamental analysis is you making your trading decisions according to economic events like the Forex news, employment rates, natural disasters like floods, war and more. So before you trade a certain currency, you must understand what is going on in that particular country. Let's say you want to trade a USD affiliated currencies. You must understand what is happening in the US, so you can understand how you manage your trades in that particular day or that period. Technical analysis, on the other hand, is the use of candlestick analysis, chart patterns and indicators to make your trading decisions. This one deals more with strategy and timing. A technical analysis trader will use this to understand what is happening in the market in a particular period. In order to find trading opportunities, make sure you pay attention to everything I am teaching you gradually, as they will all be important later when I will be teaching you the strategy. One of the biggest joy of a technical analyst is that history always repeats itself in the market, so he leverages on that to make great trading decisions. Now, what is really a currency pair? A currency pair is a combination of two currencies. We have the major currency pairs, which are the currencies associated with USD. All the major currencies have dollar in them. The major pairs include GBP USD, Euro USD, USD JPY and more. These are the most traded currency pairs. That means that they are also the most volatile pairs in Forex. We also have the minor pairs. A minor pair is a combination of two currencies together. It could be any currency as long as the dollar is not a part of it. These minor currencies include Euro GBP, GBP Australian dollar, New Zealand dollar, Japanese yen. These ones are less volatile than the major currency pairs, and if you are a beginner, I will always advise you stick to the major currency pairs to benefit from their volatility for more trading opportunities. We also have the exotic pairs, which are the different currency combinations of a developed country currency and small developing countries currency. These ones are to be always avoided because they are very less volatile. You may even find your country's pair as one of them if you dig deep. Now, most times on your trading chart, you will see something like this as the price is moving up and down. Okay, let me clarify it for you. At the bottom is called the bid price. This is the price of a currency that buyers are willing to buy at that particular period. The line at the top is called the ask price. This is the price that sellers are willing to sell at that particular period. That space you see at the middle is called a spread. This is where the brokers are making huge amounts of money and wrecking traders. Always go for a broker that has your best interest at heart with tighter spreads. Many of these brokers just wants to take all your money. And the truth is that either you profit or loss, they are still making money. Although other assets, like the gold, have very low spreads, you should understand the different spreads on each asset and each broker before choosing your broker and assets to trade. You can check the broker's spreads by creating a demo account on their platform and comparing the differences. If you want to know my personal broker and the type of assets that I trade personally, join my Telegram channel. You will also be able to see my trades there. The link is in the description. Alright, let's move to the next popular trading term. A lot size. A lot size is the number of currency units being traded in a position. And this is where many traders make costly mistakes. Though the brokers will give you a good leverage to trade bigger lot sizes with small accounts, but that does not mean you should. Just because with a $100 balance, you can trade with a lot size meant for $1,000, does not mean you should trade with it, my brother. Your account will be like a goat, trying to carry an elephant on his back. Everybody knows what will happen later. Of course the goat will not survive it, and that's a more reason why each time someone joins my premium signal group, I always give them a calculated lot size table that contains my recommended lot size on each asset that I trade, which will be suitable for their account size, all the way from $20 to $10,000, making sure their account is protected from high lot sizes. Don't trade a lot size that will be too much for your account, else you turn your trading business to a gamble ground. And I don't want you to do that. Forex is not luck. It's a game of strategies and timing. We're gradually approaching the strategy that I am about to teach you in this video. Make sure you hit the like button and subscribe if you are new to my channel. And as you subscribe, you automatically become a family member of the Trading Tribe family. I know you are into Forex to make money. This is not about passion. I know you well enough. But hey, when we trade, what's really our aim in the market? How do we intend to deposit money and make big withdrawals to our bank accounts? Yes, our major aim is to buy low and sell high. Many traders are preaching that, but only a few are practicing it. I still see professional traders that always sell at the lowest points when the price is ready to bounce back and start a new trend. But hey, that will not be you. I will show you how to enter from the low and sell from the highs, so that you can be making more pips easily. But hey, do you even know what pips do to you trades daily? Pips is a very crucial part of trading cause they represent the difference between your entry point and your exit point. You will hear traders say they made 200 pips in a day, 400 pips and so on. Pips helps you to know exactly how much you will make in a trade even before you trade it, and you calculate it by multiplying them with your desired lot size. For example, if you're looking on making 300 pips for a trade with a 0.05 lot size, that will be $300 multiplied by 0.05, which will give you $15 as profit or loss. You can go higher to multiply it with 0.9 or 1.0 lot size, and that will give you a different amount. But hey, always make sure you are risking according to your account size. Don't overlot, before your account will blow away like harmattan wind. To know the number of pips, use your crosshair tool and hold it on the beginning of your trade. Then drag it to the point you want to calculate the pips. Any number you see after the zeros is the amount of pips you will be making. Very simple. Greedy traders can drag it as high as 2,000 pips, but hey, that's your money and your expectations. Now it's time to show you a simple strategy that you can begin to use as a beginner trader to make at least $100 daily. On the chart here we have the support and resistance lines, a very important tool used by the big banks, central banks and hedge fund traders. Each time you trade the support and resistance correctly, You are not the only one spying on that opportunity. The big banks and many retail traders have eyes on it too. Support levels act as floors that prevent prices from falling further, while resistance levels act as ceilings that prevent prices from rising higher. We also use support and resistance levels to identify potential reversal points and to set stop loss and take profit levels for trades. The support and resistance levels forms as a result of strong trading activity at a particular area on a price chart. And as traders, we believe that the market repeats history, and we leverage on that belief to discover the support and resistance lines chart. It takes 2 evident touches for a line to be called a support or a resistance level. Those support and resistance helps us to make good decisions in reversals and the crucial points in the market. But as a beginner, you need something easier, something faster and simple to understand, a tool you can use to trade the trend correctly. And that's where Trendlines comes in. A trendline, just like the name implies, is a tool used to trade the current trend of a market, the uptrend and the downtrend. And they are very simple to identify on the chart. You draw out a line from 2 lows for an uptrend, or 2 highs like this one for a downtrend. Then you extend it and wait for price to return to the line. Now this is the most important part of it, as sometimes the market can return to break the trend line and change the trend. So what do you do when the price returns to the line? You watch out for a pin bar candlestick. Some people call it the hammer candle, but the name does not matter. What matters the most is the structure. It has a small body at the end of the candlestick and has a longer wick from price declines. Anytime you see this on the trend line, then it's time to take a trade. On this chart now, see that we have a pin bar formed on the trend line, which is an indicator telling us to enter the trade. Then we enter. Now you can see how the market moved from that point. See the massive drop. You can use this line to wait for the next high, but if the market moves to low from the line, then you consider waiting for the next one. You can also draw out a fresh trend line from the last 2 highs in order to catch the next one effectively. The rule is that the trend line must always be drawn from 2 or more points, and when the market returns to the trend line, you apply the same strategy. You wait for a pin bar to touch it, and you take the trade. Now, here is what you must be careful of when drawing the trend line like a pro that I am teaching you to be. You must make sure that the line did not cross the body of a candle. You must always draw it on the wicks or inside the wicks. Never allow it touch the body. Some traders will twist the trend line in many ways to suit their FOMO, but not you. Professionals draw it this way to tell the market that they are not in a hurry to get an opportunity. One more bonus tip for you about the trend line. When you are trading the trend lines, avoid very steepy trend moves like this. They are not good for trading. You should always focus on sloppy moves like this one. They are more reliable. Be patient enough to wait for them. I can recall how much I lost in my early trading career, not knowing the difference between them. So take this serious, so you won't lose much like I did in those days. After sighting the pin bar, always place your stop loss a few pips beyond the last candle, and you can place your take profit at the next low. As a beginner, you should focus on using this strategy on the 15 minutes time frame, so you can minimize your loss and be making more profit from the market. This strategy is as simple as I have shown you. Don't go complicating it, else, with time, it may no longer work for you. An 80% win rate is possible with this strategy, as long as you follow all the rules I have told you. And if you want a mentor in your life that will hold your hands through this crazy trading journey, feel free to chat me up on Telegram with the direct message link on my bio. I am the Trading Chief, and it's a wrap for this video. Make sure you subscribe so you don't miss out on our next video. Watch this video for a full premium breakdown of Forex trading, which even includes the history of Forex trading. See you in the next one.